Hey, ladies and gentlemen. Our first question is related to the radioactive married put techniques. It comes from Terrie, who is an owner of the blueprints and the home study kit, I believe. And Terrie's question is related to the married put structure and what happens next. And she asks, let's say we bought a stock at $150 per share, and we bought puts at a strike price of $160. Standard in the money structure, maybe 5 to 6 months out, we would look for in a radioactive trade. The stock goes up to $180 per share. Do we roll the put? How do we manage the protective puts based on large changes in the underlying? Well, we're going to show that. But first, my initial response. To answer a question now, the answer is yes. One of the ways we can do it is income method number 4, and it's likely my favorite income method as it usually reduces the risk by more than 50% or more at the first run. The first time it's used. Usually reduces the risk more than any of the other income methods. It can even likely bulletproof the trade in the right conditions as your first income method. There's actually another way that can be used in this situation to adjust the put option that we shared during December webinars with the bulletproof example on Yandex. Is bulletproofing possible? We showed a method that could be used called the bulletproof vest to, even though we've only been in the position 10 days, Yandex was up only about 4% from where we opened it, I could have bulletproofed the position ahead of earnings, which are coming out in late January, with no risk to the downside and still unlimited upside profit. But if you want to stay in the stock for longer term, because you expect further growth, income method number 4 is the way to go. And I told her, of course, take a look at the chapter on income method number 4, and you'll see the benefits, do's and don'ts, and more for this adjustment in the blueprint. All right, so we're going to take a look at an example, different stock, similar movement, well, more of a movement, but a higher price stock that we use as our paper trade example from December, actually, during one of our open forum presentations. And we're going to take a look at both, an example of that income method number 4 and an example of the income method number 3 as well. Of course, Terrie later asked on position sizing for risk management, why should we be concerned about position sizing? It's the second layer of protection that's talked about in the blueprint if we've bought protective puts that limit our risk. I'm probably going to use RadioActive Trading to illustrate this notion of the double layer of protection so that the maximum risk, the maximum monetary risk I have on any married put position is still only maybe around 2% or so of my total portfolio value. Why is that important? It's twofold, and we'll take a look in just a moment. Now, let me pause the screen, and let's navigate over to the Power Options suite of tools, which we're going to use to illustrate, of course, the views of Terrie's question and the other questions that are rolling in. Okay, we'll make sure the view comes up. All right, ladies and gentlemen, what you're looking at here is the basic setup of a Power Options trial account. Those of you who are just getting started, I of course encourage you to take advantage of the 4 steps that are shown over here on the across the center board, I should say. You can get access to that free quick start guide to start reviewing some of the tools and Power Options. You can navigate through the free flash tutorials to help you get more familiar with the search tools, option chains, and more. We offer a variety of archived and free webinars that you can join us for at any time or go through the archives. And any trial member or subscriber can also schedule a free coaching session, essentially a 45-minute phone conversation with myself or Ernie, where we will walk you through the tools on the site and answer any questions that you have. Okay? All right. Now, to Terrie's question, I'm going to navigate over to the portfolio, and we're going to take a look at the Shopify position. Back on our open discussion on around December, I believe it was 6th, we looked at an example of purchasing Shopify on December 3rd when it was trading at $350.66. Proper structure of a radioactive trade, I would have bought the June 380 put, which at that time cost $58.80. Terrie, of course, asked about a 150 stock and buying the 360 put, and now it's up to 380. We're looking at an example where we bought stock at 350, bought the 380 put to control the risk, and the stock's now up to $404. I want to highlight this very quickly, so I know it's a little bit hard to see, but we're going to show this in graphical view and better. The stock's gone up $54. My put has declined, that's true, but it's only dropped 21, less than half of the gain in the stock for the proper structure. I'll get to this comment later, but Mike just posed a question. Mike sent in a question. It says, what is a reasonable expectation for performance of a radioactive trade versus buy and hold? Well, this is sort of a perfect example. The stock's up 15.4%. I didn't lose my put, I should say, because the proper structure, Mike, didn't go to zero. In fact, it lost less than half the gain in the stock. I still expect to make 60% or so of the underlying gain in the stock price as it moves up. But if Shopify had fallen 15%, I'd only be looking at a loss of 3, 4, or 5% on the position. So, take 10 random stocks. Think about 7 of them moved up 5 or 6% as you expected. You'd still make maybe 3% or so on the married put position without doing any of the income methods. One of the other stocks is at break even. You didn't gain or lose anything. You might have lost 40 or 50 cents of time value on the put in the first month, depending on the structure. This might have been $2 or $3 because it's much a higher strike put. Then the remaining 2 stocks, one dropped 5%. You'd be looking at a 1% loss in the married put position, and the other stock fell 15%. And you'd be looking at only a 5% loss in the position. I'll have to find a comparison I did with that structure last year, where I had a basket of 10 stocks and showed just how they performed over a 1 or 2 month period and how they would have looked had you done it with the married put position. So what is the expectation? I still expect to make 50 to 60% of the upside profit, not including the income methods and adjustments, or if I bulletproof the trade, whereas any stock that falls, I'm going to be losing less with the married put structure. So depending on how your stock performance of buying and holding goes, Mike, you can sort of take that and say, okay, well, if I only made 60% on the winners, but I controlled the loss to only 5% or less on all of the losers, would you have performed better with the married put than your buy and hold strategy? My guess is you probably would have. Okay, but I'll try to find that for you later next week or this weekend. Back to Terrie. Here's my position, up 15%. Have the put in place. What do I do with this put that's down in price? It's now out of the money, but it's not at zero. It's still retaining a lot of its time value. And one of the advantages of the power options tools for any strategy, not just the married puts. I'm going to go to position actions from that more information menu and position analysis. This is going to give us a breakdown of our current position. Well, there's the profit and loss chart. Just a little bit skewed because, it's so far above our original purchase price, 15%. I'm still at a liquidation value of 8% after 30 days. I haven't lost a lot of time value on the put, and it did not go to zero. Okay? In that case, all right? So we still have a lot of time value remaining in this put, even though it's out of the money, because it was properly structured to begin with. Okay? All right, so that's just one. I can see where my current liquidation value is compared to my future expiration value. Then down below, we show potential rollout opportunities based on the rules in the blueprint. If I was tracking a covered call, I'd see rollout opportunities here to enhance returns and more. Or if I'm in a credit spread, a naked put, you'd see rollout opportunities. Now, the first obvious income method is, hey, the stock's at 404.76. I can sell a 405 call. I can sell a 49-day out 405 call for $28.90 and almost bulletproof the position right away. I'd have a new maximum risk of only 0.1%. Why wouldn't I do this? Well, this is where that SIGA model for the various income methods come in. Let's take a look. Great to see things numerically, but as I'm evaluating a rollout opportunity, I'll go to Simulate Trade, and now I get a side-by-side picture. Income method number 1 caps the upside. I'm sorry, Shopify fell down to 398.65 at the end of the day. It was at 404.60 when I was putting the slides together at around 3:30, 4 o'clock. But in any case, took a dive at the end of the market there. So here we are. And the blue line here is showing us what the new position would look like if I perform this income method. The original position is on the left. I can still get a 13.9% return if the stock's right at 405. And I've canceled my risk to almost nothing. This is not a bad income method by any stretch of the imagination, with one exception. My short call's at 405, 49 days away. I have a capped gain at 13%, but if the stock continues up, this profit starts to fall. Why? Because in our conversation we just had with Mike, when I'm in the proper structured married put, I'm still expected to make 60% or more of the gain. If it keeps going up, I'm going to expect to make 70%, 80%. Yes, the put's declining, but I'm gaining more on the stock than I'm losing on the put. Even if the put goes to zero, I would have gained a lot more on the stock than what I paid for the put for that put to go to zero because it's still out to June. Okay? But as the stock continues to go up with that call sold, here on the original married put, I have the advantage of a positive delta. Here I've canceled that because now for every dollar the stock moves above our short call strike price, I have a delta wash. I'm delta neutral, aren't I? Because that short option delta is eventually going to go to 1 in February, and my June put still has a negative delta. So I start to give back as it increases. That's not necessarily a bad thing if I don't expect the stock to go up above 405 by February expiration. But what I have to keep in mind when doing this, and this is all part of that SIGA model, which is described for each income method in the blueprint, here is our stock detail page for Shopify. Earnings are expected on or around February 11th. If this stock has another 10, 12, 15% gain from strong earnings, do I want to have a capped position in place? No, I'd much rather have low risk to the downside and leave the upside open to take more advantage of that large run rather than being forced to buy back the call. So although this income method number 1 position, just selling a call, looks pretty good and can almost bulletproof my position, it doesn't answer Terrie's question, but there's other thoughts behind why I would not do it, and that's all described in the blueprint. Okay, so back to Terrie's question. We scroll down, we see other adjustments. All of these highlighted in red are now bulletproof positions. This is the income method I showed with Yandex, income method number 3. Did my June put, decline as the stock went up? Yes, it did. But it didn't go to zero. I still have time value, $20, left in that June put because of the proper structure. I could sell to close that put and move it closer in time for half or maybe even a third of the cost and keep the same or even higher insurance and have no risk on the trade. This would be a bulletproof position, no risk to the downside, unlimited upside. Great to see things numerically. Here's our side-by-side picture. Here's our original married put in red, the numbers on the left. Original risk of 7.2%, current return of 6.5%. If I sold to close my June put for $37.40, prices changed again. It was at 20, now it's at 37. I didn't refresh the page before I started the webinar. It was my fault. However, if I sold this for $37.40, a loss of $20, but I've gained $48 on the stock. And then I buy a higher strike put, $385 for January 31st for $11, I now have a bulletproof position with unlimited upside profit potential. This is known, income method number 3, sometimes referred to as the bulletproof vest. This is not an income method I would use. Why? Because it's great to be bulletproof and have the unlimited upside, but earnings are coming out sometime in February. Why would I buy the January? I wouldn't. Okay, I'd go back, look at those rollouts, knowing what I know. I don't see any Februaries here that bulletproof me by rolling in. So let me go here. Here's income method number 4. Still called an income method, but it's essentially the only one that's done at a debit. This is one of my favorite ones. This is the one I use actually most often on stocks that move up for the first income method. Here, I could sell to close my 380 put for 37.30 for June, and buy a June 410 put for 52.80. No, wait a minute, that doesn't look right. Why would I increase the cost? I'm getting 37.30 back into the total cost where the purchase price of the put was already accounted for, and I'm buying something new for 52.80. I'm increasing my cost by $15. Why would I do this? Because I'm gaining $30 of insurance. I'm taking $15 off of that maximum risk because the increase in strike prices, and I'm still keeping 168 days of insurance. The new risk is 3.5%. Cut it in half from 7.2. And once again, great to see things numerically. Want to see it graphically? Oh shoot, let me refresh that. I scrolled too fast before the graph could draw itself. There we go. Here's our original married put with the max loss, of course, going down this way if the stock's below 380. We've moved that up half from risk of 7.2 to now only 3.6% or $15. We'll go through February expiration with half of the risk. I'm sorry, we'll go through February earnings, my apologies, with half of the risk. And if the stock was trading up at 405 or 410 where it was earlier, I actually looked at rolling up to the 420 strike, which would have cut this down to about 0.7% at risk going into earnings in February and having insurance out to June. That is income method number 4. It adds a debit. It's the only income method that adds a debit and adds to the cost basis, but you get a much higher guaranteed payout because of the structure of the method. Although it adds to the cost basis, it will lower the risk. This is usually the income method I like to use first if the stock moves up 5 to 6% in the first 30 or 40 days or so when I'm in the position, really first 20 to 30 days. I'll look at this first. Now, we saw some income method number 1s that were out there. They were for January expiration before February earnings at reasonable strikes of now even 405 or maybe 410 with a stock at 398. But we didn't want to cap the gain because the ones at Bulletproof were out to February, possibly past the earnings date, where we didn't want to have a capped gain. What if I could combine the two? Well, that's something I can do, and in this case, Terry, rather than use the position analysis view, I'll just go to the standard profit and loss chart. We have our initial max risk on the Shopify position, 7.2%. We'll do our simulated income method number 4. And to simulate it, I have to sell to close my initial 380 put first and buy the second. So we'll scroll down to June. We are going to sell the 380 for that $37, $38. Yeah, when it was at 405, this had dropped down to about 27 or so. It was $10 less. That's okay. And we're looking at the 410. We're moving up 30 points, but paying a $15 debit. So I'm going to sell to close the 380, buy the 410. Okay. And we're down to that risk of 3.2, 3.3% as we saw before. About $15 worth of maximum risk. We know earnings are coming out in February. But I also know I have several expiration cycles between now and that concern. Let's go 21 days out. Let's go to January 24th. You know our stock's at 398. I may consider selling a call. I'm rolling up to the 410 strike of the put. So almost $14. The 410 call, January 24th expiration, prior to the earnings. So if I think the stock's going to bounce around between this 395 and 405, this is not a bad strike to select. We'll sell the call in combination after doing the income method number 4 position, combining income methods, and I'm back to a risk of almost nothing. Max return of 10.8% if the stock's trading right at 410, but if the stock stays below 410, and on January 24th this call expires, I now have a risk of almost nothing heading into February earnings. So those are the advantages of how you can use the put option. 2 different ways. We showed income method number 3, the bulletproof vest. You want to know where your earnings are and where to extend it. And income method number 4, cut our risk in half by itself, but combining with the short call, with the proper rules discussed in the blueprint, you can get close to bulletproof status, of course, and even in this case, get off, I might make it through January earnings, I'm sorry, without having to buy, roll, or adjust, having this expire. Now I'm all set for February earnings, only 0.1% risk. And yes, Terry, this is going to be recorded. This is recording, my apologies. And it will be posted later this weekend for further review. Now let me navigate over to RadioActiveTrading.com real quick, and I want to show something here. Oh, I'm sorry. I got to log on. I hadn't logged on yet. Sorry, so let me do that real quick, folks. Your screen is paused. You're not looking at RadioActive Trading right now. You're still looking at the graph, I believe, of the Shopify position. Okay, so I'm going to go ahead and I'm logged. There we go. Sorry, folks. I'm at RadioActive Trading, and I'm logged in as a Fusion subscriber. I'm going to go to the RPM report, which is very similar to the Power Options Married Put screen, except for you can't adjust the criteria. One thing that I can adjust, however, is this. That second layer of protection that Terry was asking about. So what she was saying is that this position up at the top, Yandex, different from the one that I'm in, carries an 8.2% risk. The one that we opened during our webinars for a new Fusion position was actually a 47 strike put, when the stock was around the same price. Carried a risk, I think, of only 6% or less. In any case, Terry's question is, if this married put only risks 8.2%, why am I worried about position sizing? It's one of the first few chapters of the blueprint. And what that means, if my max risk is $391, or $391 for 100 shares, I don't want this to represent more than 2% of my total portfolio, or what I'm allocating to RadioActive Trading. Why is that important? So up here we see the total portfolio value and how much you want to risk per trade. So let's say I'm allocating $40,000 to RadioActive Trades. I just got off a conversation with a gentleman who was allocating about $50,000 to radioactive positions. And I'm going to allow this to go up to 2, meaning this monetary amount is going to represent 2% of my total portfolio. So this tells me how many contracts I can trade. So what does that mean? That means to control it to 2% of my total portfolio on the Yandex position, I'd buy 200 shares and 2 puts. That put me at a risk of about $800. Okay, $782 of the 40,000 total. But Terry, what else does this control? Well, the total cost is $47.91. So we're at about $9,400. So that's 1/4 of that total allocation. I'm okay with that. I might only carry 5 or 6 positions at a time. I could choose to only open this with 100 shares and 1 put, just put out $4,800. And of the money I have allocated, still put me about $35,200 to open 3, 4, 5 more trades. But why is it important? Why wouldn't I take, if this was the 40,000 and I was really interested in this Yandex position, why wouldn't I buy 1,000 shares? Okay, well, I couldn't. I'd need 47,000. But, okay, why wouldn't I buy 900 shares and 9 puts, which would be risking 2,700, right? Because now that would be close to representing almost 10%. So if something happened with Yandex and it completely fell out of the bath, sure, I'm only losing 8.2% of that total portfolio value. If I did 1,000 shares and 10 contracts, if I had the funds to do it, I'd only be risking 8.2 of my total portfolio. That's good. But I would have used all the capital I had allocated to RadioActive Trading in this case on that one position. I'd rather have 3 or 4 positions open with that second layer of proper position sizing. You notice here that the New Oriental Trex, I did that a couple years ago, but New Oriental and Trex shows me 0 contracts, as does PayPal Holdings. Why? Because at $40,000, I can't buy 100 shares of the $126 stock, the $88, I could actually of the $88 stock, but it wouldn't match my needs. And of course, the PayPal Holdings one here, the risk would be above the 2% of my total portfolio, so that's why it's not showing. That's why it shows 0 contracts. But that's why I'm not going to lump everything I've allocated to radioactive trading into one position. That's why that 2% rule, that second layer of protection comes in. And also, if something unexpected happens, which happened to me last year, I think I had a stock, or 2 years ago, I had a stock fall 63%, Iconics Brands, I believe. I did get a profit of 4% roughly on the position, trading it radioactively with the income methods, but I held it the entire time. I held stock the entire time, and it was down about 60%. But it dropped 35% in the first 5 days of the trade. An unexpected event happened on Iconics. The CEO decided he was going to step down, and shortly after that, the CFO said he was out too, almost looking like they were trying to get someone to fudge numbers for an upcoming earnings, and the stock plummeted. Thankfully, I was in a radioactive trade. Thankfully, I adjusted it, expecting it still to drop, and turned it to a profit on the position. But if I had put everything into that, it might have been a full 8% loss in that first decline, rather than it only being 1.5 or 2% of my total portfolio value. That's the second layer of protection. Allows me to diversify, allows me to do more as well. More trades, I should say, without allocating everything to the safety on that as well. All right. I think that answers that. That's our wrap-up for Terry. And we're going to go back to Power Options now and go through our other questions that came in live over the past 20 minutes or so. Eric is up first. He says, this is my first open forum. Happy New Year. Happy New Year, Eric. I'm sorry it took us 30 minutes to get to your first question. But usually when we have a couple questions come in via email, that first 30 minutes usually devoted to that, and then we jump right into live ones. Okay, Eric, your question is related to how to deploy capital, how to go from 100% cash to fully invested. Should I put on 1 or 2 positions? And I kind of already answered this. 1 or 2 positions and wait for them to be bulletproof before putting on the next couple of positions? No, I wouldn't say that. Follow those rules, Eric. Okay, follow the rules that we just talked about. Let's think about this for a moment. I'm going to go to the married put and I'm going to go to search. And so what I'm going to say, Eric, is if you mean the money that you're in cash right now, you're going to allocate all of it to radioactive trades, that's fine. You could allocate 60, 70% of it to radioactive trades and maybe play with some credit spreads with 5 or 6% over here. You probably have all heard me say that about 50% or so of my total funds are allocated to the radioactive trading technique. 10 to 15% in bull put credit spreads following the power options screens and the testing that I've done. Another 10% or so might be in diagonal spreads depending on market conditions. I may still have a long collar open, and then I might be doing 5% of my portfolio with long straddles around earnings as we're going into the next earnings season as well. You have to decide that for yourself, but let's just think about this again. Let's take those numbers. I have $40,000 that I'm going to invest in radioactive trades or allocated to radioactive trades. That secondary rule we just showed that's talked about in the blueprint says that I should only, the monetary risk, this monetary risk, the maximum monetary risk should only represent 1 to 2% max of my total portfolio. Nothing wrong with using 1%. I might push it up to 2%. So if I was to open positions today, just taking the top list, I'm going to start to fill out, I should say, my $40,000 allocated capital, knowing this rule. If I just pick the top 3, I've got Yandex, which I'm already in, and we talked about that cost basis with the put being at $47.91. Max risk is $391, under $400, so I can do 200 shares and 2 puts. That would be $9,400, right? A little bit more than that. Let's go ahead and call it $9,500. It's right about 48. It's probably closer to 9,600. It's like 9,580, right? So anyway, okay, let's call it 9,600. Scratch that out. Okay, so 9,600 of the 40,000 into Yandex. Next position, Qualcomm, risk of 747. Let's clear that up. You can see it better. Okay, so Yandex is checked off with $9,600 roughly into the position. 9,580, okay? Maximum risk, 747, so I can only do 100 shares of Qualcomm. This was one I was actually considering when we opened the Yandex position and the FL trade, the FN trade, not Fortinet, but the other one, during the webinar series in December. In any case, so I just do 100 shares and 1 put. That's going to put me at 94.97. Okay, so where am I now? We can call that 9,500. Well, already, 2 trades, proper position sizing. I'm only risking about 2% of my total portfolio value in each trade, but we're $19,000. We're half of our allocated funds into the position. Third one, Jabil Circuits at 353. I can afford to do 200 shares of this one, $48. Again, I'm at about that $9,000 range. So now we're up to 28,000. And then 100 shares of Trex. Oh, I missed one. Oh yeah, I can't do New Oriental. It's too expensive. But if I did do 100 shares of New Oriental, it'd be at 14,000. So right now I'm at 37,000. 4 trades. I could choose to just do 100 shares of each and do up to 5 or 6 trades if I wanted to in this case, Eric. But following the rules, I'd only be opening 4 positions, and I'd probably scratch New Oriental, and I'd probably have Qualcomm, Jabil, Yandex, and Trex with 200 of both Yandex and Jabil and 100 of Qualcomm and Trex. Even if I took the max loss on all 4, I'd lose less than 8% of my total portfolio value because of the proper position sizing, and not put all of my eggs in one basket on Yandex, which also carries a full 8% if I tried to do the 1,000 shares in 10 contracts. That's the second layer of protection that allows us to diversify and diversify. A side note there from Eric, he says, this is a great service. Do you do this every Friday? Yes, we do. Every Friday at 4:30 p.m. we have an open discussion. Doesn't always start off focusing directly on the radioactive trading techniques, but because, of course, we just wrapped up the end of the year promotion, which was extended, by the way. So if you thought you missed the special bonuses, Ernie decided to extend the offer through Wednesday, January 7th, I believe it is, or up to January 8th. So it is extended. You can still pick up the blueprint and get all the advantages. But sorry, Eric, yes, every Friday at 4:30. All last year except for holidays, and once or twice I was sick. 4:30 to 5:30 we do our open discussions for all investors free webinars. Okay. Mike, I had told you my apologies that I don't have it. I can't pull it up right now. I've got to find the presentation I did, Mike, and I'll try to find the graph there. And what I'll do, Mike, is I'll try to get that to you where I showed that comparison of buy and hold on a 10-stock block versus doing the married puts after a 30-day, 60-day period. I have it somewhere, just have to find it. Okay? So I'll find that for you, Mike, and get you an email probably later this week, and hopefully by Sunday, if not, definitely by Monday. Okay. All right, so next on our list, we've handled Terry, we've handled Eric, we handled Mike, and this is... Sorry, it's not giving me the full width. Al. Great. Excellent, Al. Al says he has a couple of questions. Is there a radioactive trade service in place? Yes. I go back here to radioactive trading. This is where I was logged in now. And, sorry, let me go to the Blueprint and Fusion tab. So what's available on the Fusion service is you get access to the lessons. These are timed lessons that Kurt and myself put together so to help you expand on the concepts taught in the blueprint, see more examples of income methods and other concepts. The married put search, we just showed that as well. The stock insurance tool, so if you have a stock that has an unrealized gain, you can use this tool to see which puts would best lock in profits for your position and your expectations, and the members-only webinars. And then there's the open trades and trade tracker. Okay. And so this is where we post all of our trades. Myself, Ernie, and Greg actively post all of our trades. See, Ernie's got a couple bulletproof positions there, Blackstone, Ring Central, and Health Equity. His most recent positions were opened in December, November, and October. The 2 positions, Yandex and Fabrinet, that I just opened, I could have bulletproofed really close to less than a 1% risk on Yandex the other day. We showed that in one of the webinars that's archived on YouTube, but I chose not to do it at that time. Fabrinet is still up. It's up about 2.5% right now. And then the on position, which I've been in for too long, I'm going to take the 5.9% loss on this one. And then Greg's got bulletproof positions and some gains on his positions as well. Fusion subscribers can see the full track record, but when you click on the track record, you can see Ernie's, mine, and Greg's. And what we show here on the track record is just the performance of the positions. And we show the records for the Fusion subscribers as well. It takes a minute to load. It's got to go through the API, Al, and grab all of that information. Okay. All right, there we go. Okay, so you can see here that, on average, this is just the average over since September 2007. 79 total radioactive trades. Ernie's got a success rate of 52%. He makes 10.4% when he's right on average and loses 5.4% when he's wrong with a winning ratio. You can see each individual one here of the profit and loss, of course, as a Fusion subscriber. And mine is available there as well. I don't make as high, as an average return. My average return is only 7. My risk is a little bit low at 4.8. I only have 67 married puts, but I have a 60% success rate, wins versus losses. Okay, so Ernie does a little bit better with the management and stays in his positions a little bit longer. My average hold time is about 140 to 130 to 140 days. His is closer to 210, 220. Okay, days in a trade. He milks them extra to get that higher percentage return in that case. Okay. Now, why aren't we showing? And then, of course, you can see the individual trades here as well. There's the one. Oh, here's Penn National. This is the one that dropped 33%, and I had a 10.3% profit. That was one of them. I was looking for Iconics. That must have been 2 years ago. Oh, there's that Trex position there. Made 7.1%. The stock was only up 5.6%. Maybe Iconics wasn't as big as... Nope, there it is. Yeah, Iconics is the one that I was in stock the whole time. It dropped 66% from 2015, but I took a 4.1% profit on the position in that case. Okay, so that's what you can see. Now, why aren't you seeing it sort of as a portfolio view? Why are we showing it in the simulation fashion? I post every trade as 100 shares and 1 put, just for the reason, Al, that we just discussed as well. And what is that reason? It's that we advocate the proper position sizing of these positions based on your account size. I don't know what your account size is. I don't need to know. We put them out. These are my own radioactive trades. They're all my real radioactive trades, Al. Okay? Sorry, I'm checking the sound there. It looked a little strange. It had pegged out and it had stopped moving, so I'm not sure what's going on. In any case, ladies and gentlemen, these are all my actual trades, but I only post them with 100 shares and 1 put. It's up to the Fusion subscriber to decide based on their account size, are they going to enter that trade based on their position size and what they have left in their account? Are they going to do 200, 300, or 400 shares, or that as well? Okay, so that's sort of the idea why we're not showing it that way. We're showing the simulation of what we'd expect if you did have a 60% win ratio, got an average 7% gain on your winners, double what you'd expect over a covered call, and kept your losses to only 4.8%, probably less than half of what you'd expect on a covered call, even with a 7 or 8% stop order, because some of those are going to blow through it. And even if you're right 60% of the time, you're going to vastly outperform that strategy, and possibly others as well. Okay? The goal is to be right more often than wrong, but this is the only structure I know of where I can be wrong more often than right and still make money because I'm fighting gambler's ruin. In other words, if this is still my average return or my average loss, I could still be right only 46% of the time and still show a potential profit on my portfolio. All right. So, oh, and Al, I'm sorry, the annual return that we target and we expect to make is, I've been able to make, I don't have it. Someone asked me about it. I haven't done this year's yet. Last year at the end of 2018, I did it, and my average was hitting my target. It was a little bit above. Ernie and I expect that in good markets such as last year, you should expect around 12 to 15%, possibly without even the income methods at all, just the structure of the married put, because you're keeping most of those ones on the ones that you will lose on, and you're still taking advantage of 60 to 70% of the upside. 10 to 12% annualized with this portion of my portfolio is my target. As of last year, my average was 10.8% over the last 6 years. And this year, I did not make my target. I'm going to be honest with you. I held positions longer than those 3 positions we saw, not the 2 new ones, but the 3 positions in NRG, Dell, which I'm going to manage soon, on semiconductors, which I'm going to manage soon. I held them for too long without just getting out with a 1% loss and opening new positions to take advantage of that better September run. I repositioned Dell twice, and I have a good way to manage it coming up in the next few days. And I have a way to manage NRG. I'm just going to take that 5% loss that you saw and move on, right around the average of my 4.8%. Didn't hit my mark this year, and it was just because I was trying something a little bit different. And I'm not going to do that again for next year. Ernie's positions, he exceeded his goals for this year, as you kind of saw there with the 3 or 4 bulletproof positions he has right now. Okay, well, ladies and gentlemen, that looks like the last question we had there, even though it took me twice to do it for Terrie in that case, because I lost the question. I got sort of pulled off there, of course, but I just want to remind everyone here that today's material are my thoughts on your questions designed for educational purposes, increasing investing knowledge and options performance. And a lot of the questions today were on radioactive trading, which is absolutely fantastic. Naturally, something I'm very familiar with. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. Yes, I have a position to open in Yandex that we saw. I'm not opening a position on Qualcomm next week that we saw in the married put search. I'm not opening a position on that second one that we saw there as well. I already forgot what it was. And I don't have a position in Shopify. We just use that as an example. Options do involve risk and may not be suitable for all investors, which is one of the reasons why we advocate the married put radioactive trading technique there as well in that case. Okay, just want to remind everyone, of course, as we're going through that, just want to remind everyone the conversations we had today about limited risk trading, the content discussed in the blueprint for the different income methods and the proper structure is all available in the blueprint. And everyone that asked a question about the blueprint, I referenced them back to the blueprint, and you can still get access to the end of year special. We extended it through January 8th. It has been extended, so you can take advantage of the 8 bonuses if you pick up your blueprint by January 8th and still get all of the free benefits, not to mention the benefit of limited risk trading and the 12 different income methods to help you get to bulletproof status as well. If you like what you saw in the Power Options tools today, we showed the portfolio and navigating the portfolio to evaluate rollout opportunities, not only on married puts, but on any of the strategies that are supported, covered calls, naked puts, calendar spreads. See rollout opportunities where we do the math for you, the patented search tools in 23 different strategies, other market indicators, the market sentiment tool, and more. Well, if you haven't tested it out, go to powerop.com. Just put in your name and email address, and you'll have full access to the site for 14 days. Subscription levels start at $45 per month after the first 14 days, and they go up to include historical, full data, full access to the 9 or 10 years or so of historical data that's available, and real-time quotes as well. Want to check out other education? Remember, go to the blog at any time, blog.powerop.com. You can also check out our free webinars page, powerop.com/webinars.asp. Showed that at the beginning of the presentation, but you can go to it as a public page. Some of the webinars are reserved for Power Options subscribers and trial members only, and some are reserved just for subscribers only as well. But you can see a lot of our free content. Of course, you can always check us out on YouTube also. All right, well, ladies and gentlemen, Zaid did send in a last-minute question that I didn't get to, but I think he departed for the evening. I will answer him via email. And remember, if you think of any questions later on, just send us an email anytime to support@powerop.com or to support@radioactivetrading.com. You can reach us during market hours at 302-992-7971. And remember, those of you that are on a trial or subscribers to Power Options, schedule a coaching session at any time. It's not a sales call. It is just like this. I just answer your questions with maybe a little promo at the end. But yeah, it's a 35, 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site, answer any questions that you have, and show you how to use the site in a more efficient way based on your needs and what strategies you're focusing on. Well, ladies and gentlemen, thank you again for a very powerful and a very spirited discussion on our first open discussion of 2020. I look forward to seeing you all in the future weeks, and you'll receive emails from me this weekend regarding our other upcoming webinars next week as well. Take care, everyone. Have a fantastic weekend. We'll see you soon. Good night.